Good evening, everyone. Are you able to see me? Am I audible to all of you? I believe yes. Good evening, everyone. Yes, good evening, Sridevi. Good evening, Rahul. Good evening, Anjana. Divya, Manjula. Good evening, everyone. Shall we restart now, friends? Perfect. Let's restart the next session now. Yes. So, friends, pre-break we have done bond valuation, we have done portfolio, we have done mergers, mutual funds. Now it is going to be one question of security valuation followed by futures and forex. Shall we begin now, friends? So, security valuation question number one. 1 minute. Security valuation question number one. They have told there is a coupon rate of how much percentage? 14 percentage. Okay, 14% non-convertible debentures on 1/1/2007. On 1/1/2007. Right. These debentures have a face value of 100. Face value is equal to 100 and is currently traded at a market price of how much rupees, friends? 90 rupees. Interest on this will be paid through post dated checks. So this sentence is where they create a confusion. Post dated checks, but it will be paid in advance. That is the unnecessary sentence. Post means afterwards, advance means before. So net effect is nullified. There is nothing to do with this sentence. This has been given only to confuse you. Interest for the first 3 years will be paid in advance through post dated checks, while the last 2 years PDC will be issued at the end of the third year. Ultimately, you get the cash flow at the end of every year only. So it really doesn't matter whether it is a post dated check or no. And the bond is redeemable at par at the end of 5 years. So, what is the life of this bond? 5 years. Can I also find out the coupon amount? Coupon amount will be how much, friends? It will be 14 rupees. Okay, from that they are asking you to calculate the following. First, they are asking you to calculate the current yield. What is the formula for current yield? Coupon amount divided by current market price. Then they are asking you to find out the YTM. There are two types of YTM. One is after considering time value of money. Other one is without considering time value of money. For this, the formula is what? Coupon amount plus redemption value minus issue price divided by life whole divided by RV plus IP divided by 2. Okay, that is with time value of money. Without time value of money is what we call it as the IRR method. Then they are asking you to calculate the duration. For duration, we have learned two methods. The first method is the table method and the second method is a formula method. Am I right? Okay. So please try doing until volatility on your own. I'll give you 5 to 10 minutes of time. Please try doing it on your own. Friends, shall we check now? I hope my audio is comfortable to all of you. Okay. So, friends, first one is current yield. Did you get the answer as 15.55 percentage for that, friends? Yes. Second one is yield to maturity. Okay. So, for yield to maturity, did you get the answer as 16.84 percentage? That is without considering time value of money. Okay. Third part, we did YTM with time value of money, where you did interpolation and you would have got the answer as 17.13 percentage. Fine. After this, we have average duration of the bond. So, duration of the bond can be done either use on based on table method. That's what they have done over here. They get 3.85 percentage. Sorry, 3.85 years, or it can be done using formula method also. I'll slow down a little bit, friends. I think you all must have reached here. So please continue doing from here onwards. Okay. And whatever earlier also you can read through it and understand and do it. Friends, are you all done? So did you get 3.85 years over here? And same answer did you get using the formula method also? 1 plus y divided by y minus 1 plus y plus n into c minus y divided by c into 1 plus y whole power n minus 1 plus y. So you get 3.844 years, and volatility is nothing but duration divided by 1 plus yield. When you did that, did you get the answer as 3.29 percentage? Or the logic of 3.29 percentage is for every 1% change in the yield, price is supposed to change by how much percentage? 3.29 percentage. But will the price exactly change by 3.29 percentage? No. Due to what? Due to convexity of the bond. Everybody clear with this part? Okay. Then they are asking you revised price if the yield is going up by how much percentage? 1 minute. If the yield is going up by 75 basis points. 75 basis points means 0.75 percentage. Alright. So for every 1% change, you have 3.828% change. So for 0.75%, your change will be 3.28 into 0.75. That will turn out to be how much, friends? It will be 2.46 percentage. Everybody clear with this part now? Okay, right. So we have 2.46 percentage. So that way what will happen? If right now the price is 90, the price will fall down to 87.79. Can you write down this also in your books? Alright, friends. Once you are done with this, the last question is calculate the realized yield. Friends, the word realized yield means IRR. What is IRR? IRR is nothing but the rate at which your NPV becomes 0. So here what happens is they told that intermediate coupons are not available for reinvestment. So what happens? Year 1 you're supposed to get 14, year 2 14, year 3 4 5, all the years you're supposed to get 14. So what is 14 into 5? 14 into 5 will turn out to be 70. Alright, this 70 along with the 100 total will become how much then? It will become 170. So total 170 will be the amount that will come in which year? In the 5th year, with a multiplier of 0.529, and therefore his NPV should become 0. So this 0.529 we have to go to the present value table and we are supposed to find out. Alright. So the best way to do that is we can take the IRR. We can do interpolation. So what they have done, and okay, so using interpolation or whatever, you ultimately get the answer as how much percentage? 14 percentage. Can you write down this and finish it off? All right, friends. So we are done with this question. Shall we go to the next question now? Next is a question on futures, and we have got one of the best questions on futures. Okay, friends, in this question, they have given you the price. Am I right? Okay, they have given you the number of shares. From these two, can you find out the market value? That is the first thing you can find out. Once you get the market value, can you find out the weights? Then beta is given. So can you find out beta into weight and tell me what is going to be your beta overall? Come on, do it yourself. Put the table and solve it. Tell me, friends, what is the overall beta you get over here? I'll show you the solution now. You get the overall beta as 0.85. Those who are still writing, take one more minute, finish it off so that I can go to the next part. Right, friends. So I think once you get the overall beta, the next question what they are asking is to calculate the theoretical Nifty future price. So friends, how do you find out the theoretical Nifty future? What is the formula for Nifty future? I'll just write down and explain to you. Okay, it will be F0, that is futures of Nifty, is equal to S0 of Nifty into e raised to RT. Okay, so let's go down and check here. They have taken the S0, this is nothing but S0 of Nifty into e raised to RT. So when you do it for 5,900, okay, into e raised to 10.5% for 2 months or 59 days, you end up getting theoretical future price as how much? 6,000. Please write down. Alright friends, so the first requirement is done. Second question what they are asking over there is how much is going to be the contract size. Friends, how do you find out the contract size? We'll take the value of one Nifty future. What is the value of one Nifty future? 6,000. And what is the multiple in which you are playing this? It is 200. So when you do 6,000 into 200, what is the answer you get over here? Do you get the answer as 12 lakhs over here, friends? Please write down this as your contract size now. Done, friends. Then they're asking you to find out and tell an action for perfect hedging. Friends, what is the action that we normally take for perfect hedging? Come on, tell me. There are two ways. One is the formula method, which I'll explain to you right now. The formula method is S0 into, so maybe I'll put it this way, S0 of the portfolio, not of the Nifty, into beta of the portfolio into how much percentage? 100 percentage. That's how you take 188 lakhs into 0.85 into 100 percentage. You get the answer as 160 lakhs 26,631 divided by 12 lakh contracts. So you get the answer as how much? 13.35 contracts. Come on, write down this now. Yes, friends, I think we are done with this part now. So, once you get this, now they're asking for a proof. So, friends, they are saying that what will happen if the market is going to fall by how much percentage? 10 percentage. So, here, what will you do? If you are long in the spot market, you will go short in the futures market. Am I right? So, what is happening here? You are having a fall of how much percentage? 10 percentage. If you have a fall of 10 percentage in the futures market, here the beta is 8.5. So this will fall by how much percentage, friends? This will only fall by 8.5 percentage. So what is 188.54 minus 8.5 percentage? That is 172.51. But your net gain or loss will ideally become 0. That is the proof if the market falls by how much percentage, friends? Market falls by 10 percentage. Can you write down this now? So I believe you are all done writing this also in your books, friends. Can I go to the next part now? Okay. So they have given the same thing in writing once again. So we have created the proof and your net gain or loss becomes 0. Now they are asking you what has to be done to reduce the beta to zero point 0.6. Tell me what is the current beta? 0.85. What is the desired beta? 0.6. What is the reduction in the beta? 0.25. What is the value in the spot market? 188.54 lakhs. Considering this, value to hedge will be 3.93 contracts. Okay, can you write down this now? Yes, friends, I believe you're all done going through this part also. Next one, the same question. Bring down your beta to zero point 0.6, but not by selling futures, by introducing RF. So please interact with me. If you are introducing RF, what is the beta for RF? Beta for RF is 0. So what is the formula for overall beta? Beta of x into weight of x plus beta of RF into weight of RF. So that's what they have done over here. They have taken 0.85 as the first one plus 0, that is the beta for RF into 1 minus x. This should give you 0.6. And then when they sorted out, they got the answer as 54,67,000 should be retained in the portfolio and the remaining money should be invested in what? RF. Okay, can you write down this and finish it off? I believe we are done with this question also, and this covers all the permutation combination friends. All right, friends. So we are done with this question. All right. Okay. Method 2 is not something which I am very much keen on. We'll stick to method number 1. That will be good enough. All right. Now, friends, we'll go to the next part, that is options. In options, we are having two types of options. One is called as the call option, and the second one is called as the put option. So, what is the first thing that we are supposed to do? We will write down the basic data. So, write down the next chapter heading in your books, options. Working note number 1, basic data. All right. So they have told the spot they have an exercise price of 60. Okay, and then the market price of the stock is 55. S0 is equal to 55. Okay. Call premium is 9 rupees. And the put premium is how much? 1 rupee. Correct? And down they have told, they have given 4 combinations: write a call, buy a put, write a put, and the expected S1 would be, S1 would range from 50 to 70. 50, 55, 60, 65, 70. Please write down the basic data and understand the question. This is one of the best questions available, friends. Alright friends, now once you have put the data, we'll go and start with the first one, that is buy a call. Okay, you have a right to buy at 50, outside market 60. So better to buy out, sorry, right, you have a right to buy at 60, outside market 50. So better would be to buy from outside. So what will you do? You will lapse. Once you lapse it, it will become out of the money. Hence your GP becomes 0, premium becomes -9, and your net profit becomes -9. Since it is lapsed on the expiry date, there will be no cash flow. Like this, can you write down this table on your own without looking at the solution, friends? Please write it down. And yes, friends, as I requested earlier, if this class is being useful for you, please do like the video so that the YouTube algorithm understands that this is a very, very genuine session that's happening over here. Thank you so much for all your support. Please write it down. All right, friends. So just like you did buy one call, you have to do the next one also. Graph is not required. Graph is only drawn for you to explain that you have actually a limited profit and an limited loss, and you have unlimited profit in case of a buying a call. Exactly the same way. Now, what are we supposed to do? Write a call. Call option means what? Right to buy. Writing a call means we have to think from the buyer's point of view. Whatever the buyer will say, the writer will go and say what? Yes, sir. So the buyer has a right to buy at 60. Outside market buyer can buy for 50. What will the buyer do? Lapse. Writer will say, yes, sir. It will become out of the money. GP becomes 0. Premium will be an inflow for the writer, and the net profit will be 9. Like this, can you do write one call, buy one put, and write one put also? I'll give you 5 minutes time. Please do it yourself. Yes, friends, I believe you are all done writing this. Deepthi, you have a doubt. How is it minus 5 for 65 and 60 for write a call? Let's go and check. Writing a call, there is a buyer has a right to buy at 60. Outside market, the buyer can buy for 65. So will the buyer buy at 60 or will he buy at 65? He will buy at 60. So at the moment he buys at 60, buyer makes a profit of 5. If the buyer makes a profit of 5, the writer will make a loss of 5. Premium received is 9, net profit will be 4. Deepti, that's absolutely correct. Nothing wrong over there. Perfect. So friends, I think we are done with this one particular part of call options also. Now we'll do a beautiful question where they have given you the current market price and they want you to solve it using risk neutral model and binomial model. So friends, first what I'll do is we'll first draw step number 1, or we'll write working note number 1, basic data. Let us understand the question first. Hi Hina, the question PDF is already handed. It's provided in the WhatsApp group. If can somebody please share the WhatsApp group over here, or else Hina, you can send me a WhatsApp on this number. After the class gets over, I'll share the handout with you. Okay. Spot price. What is the spot price over here? 420. The price can either go up to 500 or the price can fall down to 400. RF is how much percentage? 8 percentage per annum. So what will be the RF for 3 months? 2 percentage normal compounding. Why I am putting it this way is because based on this we have to find out e raised to RT. E raised to RT will be 1.0202 or your CCR will turn out to be 2.02 percentage. And then they have a strike price. Strike price. What is the strike price that you get over here? Do you get the strike price as 450? Am I right? Yes. Can you please write down this in your books? All right, friends, I believe you're all done writing this. So now when I go it using risk neutral model, my step number 1 will be to draw a decision tree in which market? In the spot market. So everyone tell me in the spot market, how will the decision tree look like? You have 420. The price may go up to 500. The price may fall down to 400. If it goes up, you make 80. If it falls down, you lose 20. Probability 1 minus probability. If I invest 420 at 2.02 effective rate, I should get how much percentage return over here? I should get 8.484 over here. From this, I can form an equation that 8.484 should ideally be equal to 80p plus 1 minus p into minus 20, or 8.484 is equal to 80p minus 20 plus 20p, or 28.484 is equal to 100p. P is equal to 28.48 percentage. Can you write down this in your books now? Alright friends, so once you're done with this part, we'll go to the next part. So once you get the probability and decision tree in the spot market, we can go and find out the value in which market. Value in the option market. Alright. So now tell me how much will be the value that you will get in the option market, friends. First, you will take your E1. E1 is how much? 450. If the price goes up to 500, you will exercise. If you exercise, you will get plus 50. If the price falls down, what will you do? You will lapse. And if you lapse it, what is the probability of exercising? 28.48%, 71.52%. Therefore, tell me what will be the expected profit of the buyer? That will be 50 into 28.48%. Do you get the answer as 14.24? Therefore, the premium to be charged now will be equal to 14.24 divided by 1.0202. Do you get the answer as 13.96? 13.96. Can you write down this now? So this is the premium to be charged using what model, friends? Risk neutral model. Yes, friends. So this is using what model now? Risk neutral model. Same way we can go and find out using the next model. What is the next model that we have? Binomial model. Okay. Now tell me, how do you do it under binomial model? Value of a call is equal to CU into IDUD plus CD into UIUD whole divided by I. So how much is the CU that we actually found out over here? 50. So it will be 50 into I minus D. D is the down price. That is 420 by 500. Sorry. I think it's 400 by 420. Whole divided by 500 by 420 minus 400 by 420 plus CD is equal to 0. Fifty into 0.0678 divided by 0.2381 plus 0 whole divided by 1.0202. You will get the answer as 13.95. That's exactly the same answer you got earlier. Hence proven that whether you do it using risk neutral model or you do it using binomial model, your answer will remain the same. Please write down. All right, friends. So we are done with the binomial model also, and we are done with this particular question. Okay. Next, we are going to the next chapter, friends, which is interest rate risk management. Okay. So in that, the first thing that we are going to do over here is the interest rate swap. Okay. So friends, what happens in interest rate swap? We actually go by 3 steps. What is step number 1? Interest rate differential. What is step number 2? Gain or loss of each party. And what is step number 3? Swap. Alright, so in this question, you are having two parties, X and then you have Y. Fixed rate is given, floating rate is given. So based on this data, what they are trying to do is they are trying to find out the swap. So what will be step number 1 over here, friends? Step number 1 will be they'll try to work out the interest rate differential. So here if you see 10, this is supposed to be 11, friends. As a typing mistake, you get a difference of 1. M plus 0.4, M plus 0.8, you get a difference of 0.4. Net differential will be how much? 0.6. This 0.6 they will distribute among X and Y as 0.4. Sorry, this is going to be 0.2 percentage. Okay. So once you distribute, they will put this picture in line. That is, X being a strong party will pay 10% to his own bank. Y will pay M plus 0.8% to his own bank. And then X being the strong party, X will receive 10%, Y will pay 10%. Then X will say, my share of profit is 0.4, pay me that. Y will say, yes sir. Then Y will tell, please pay me M plus 0.8. X will say, no, I will pay you only M plus 0.4. So the net effect of this entire thing would be, I think you cannot put a net figure over here. We'll ignore this part. After you put these numbers, you have to go down and do the calculation. For X, received 10, paid 10, net off. Received 0.4, paid M plus 0.4. Net effect will be how much? It will be only M. Whereas for Y, the net effect will turn out to be 10.8. X, had he gone to his own bank, he would have paid M plus 0.4. But since he went under swap, he's paying only M. So what is the gain that he's making over here? 0.4. Y, had he gone to his own bank, he would have paid 11. Under swap, he's paying 10.8. The gain will be 0.2. So that way, both of the parties are gaining in this particular swap, friends. Whew. Can you just write down this in your books? Friends, I'm totally exhausted. Can we resume tomorrow after this question? Tomorrow morning at 10 o'clock. I think we are almost at the end of this. Tomorrow, if I said from 10 to 4, we will be able to finish it, friends. Let this be the last question for today. Okay. Otherwise, I'll simply rush and that will not be useful for you, friends. Quickly write down this in your books. Shivani, you have a very good point. Can we draw some diagrams in the exam? This can be drawn for you to understand what is happening. After that, you can put the steps also neatly. Okay? Steps is what will give you the marks actually. All right, friends. So we are done with this question also. We have covered a lot of questions today. And I think tomorrow we can pack up with the remaining part also. We have a question on IRF, which is a very good question. We have some very good Forex questions over here. XYZ exports. These are all Forex and derivative combination questions. They are very good ones. 364897 is a very good question. What is next after that? Let me also check. Yes, Japanese yen. Another very, very good question, friends. We have some excellent questions to be done tomorrow morning. We'll work out all of them, friends. American CAN dollar. Very, very good question. Yes, so I think tomorrow is going to be a very good and a heavy session on focusing purely on what? On Forex and interest rate derivatives. All questions are a combination of derivatives and Forex. So all elaborated tough questions which we can work out and pack up tomorrow's session. Alright? Yes. So friends, let's pack up our session with this today, friends. Thank you so much for your patient time. I thought of stretching till 4, but I'm not keeping well. I just traveled and reached back today morning. Let's pack up today. Tomorrow with a fresh mind, I'll be able to do a much better session, friends. Thank you so much. Have a lovely time ahead, friends. Take care. Thanks a lot.